Welcome to Educational Alpha. I'm Bill Kelly, CEO of Chi Association, and your host, bringing you on-the-ground conversations with business leaders, educators, and industry colleagues from around the globe. Educational Alpha is sponsored by iCapital, the financial technology company with the mission to power the world's alternative investment marketplace. Part innovator, part educator, and part navigator of the alternatives industry, iCapital offers intuitive, scalable digital solutions that have transformed how private market and hedge fund investments are bought and sold. With iCapital, financial advisors, wealth managers, and asset managers around the world now have access to everything they need to deliver the return and diversification potential of alternatives to high net worth investors. To learn more, visit iCapital.com.
In this episode, host Bill Kelly welcomes Nell Mackenzie, a financial journalist with a diverse background, including a 20-year career as a professional actress and time spent trading crude oil on the NYMEX floor. Nell shares her unique journey from acting to financial journalism, highlighting the formative experiences that led her to cover the dynamic world of hedge funds. Listen in.
Nell Mackenzie, welcome to Educational Alpha.
Hi, Bill. Thanks for having me.
It's my pleasure. I think this is going to be a very good discussion. We met several years ago. I don't know if it was pre or post-COVID. My mind is in a time warp about BC or AD when it comes to COVID. But I remember it being a very good discussion. I think maybe as always, you were under deadline. But you came across just in that brief coffee as a very smart journalist who wanted to always get the story right. And I'll pay you a compliment out of the box, having worked with a lot of journalists and reading a lot of periodicals. You are a bit of a rare breed. So thank you for that, in that caring about what you write and informing the end investor, which is what we're all trying to ultimately do. But maybe you've had a couple of very interesting stops in the course of your career, some things completely outside of our industry too, and you can touch upon those as well. It seems like most of your professional career may be in the UK, but it started, I guess, right out of college in the New York tri-state area. So maybe without going into excruciating detail, I think setting it in terms of your background would be a helpful place to begin.
Sure. So for the first 20 years of my career, I was a professional actress, which of course led me to do almost every job under the sun in order to support my theater career, including working at a silk plant factory and many waiting tables jobs. I'm very cheery, but very dreadful waitress. And also trading crude oil and being a clerk down on the New York Mercantile Exchange when it was still paper. But when I turned 40, I decided to become a little bit more of an adult because I had a kid. So I retrained, went back to City University in London and got my degree in financial journalism because I had that brief stint on the NYMEX. And I think when you experience the markets like that, it's like a severed leg that just itches all the time, even though you might not be doing it. Because I had a successful stint of my acting career, a good 10 years where I worked constantly as an actor. But even during that time, I had an itchy markets leg. So a ghost itch. So when I went back to journalism to get a degree in journalism, I definitely wanted to center on the financial markets.
And I want to just touch upon your short stint at NYMEX, because if I read it right, Nell, that was early in your career, and I think it might have been circa 2000 when that is a crazy place. I guess it's electronic now, but it's a crazy place when I knew it, probably not very big on diversity. There was always a pecking order. And the fact that you were able to work your way through that, obviously learn some things. It must have been formative in so many ways. And maybe there were some tangential experiences to being a cheery or less cheery waitress, too, in terms of having to deal with grumpy customers.
Yeah, I'll tell you what, I'd rather work on the NYMEX than in a restaurant any day. I think restaurant work is incredibly difficult. But I had a mentor who took a break on me. He grew up a lower middle class kid, like I grew up a lower middle class kid. And so he decided to Eddie Murphy me. I don't know if you've seen the movie Trading Places.
Yes.
Yeah, so I got Eddie Murphy'd. I picked out trades for him for a year. and he would give me 20% of the trade, of the profits of the trade. And I made him a lot of money that year. It seemed like I had a little bit of a knack looking through past market data and seeing the patterns, seeing what kind of cracks and spreads in the energy markets would work. And then at the end of that year, he said, well, you'll be responsible for loss. And I said, well, hang on. I understand how the gas crack works, but I don't understand the difference between bid and offer. I knew some complicated things, but zero simple things, and zero of the nuts and bolts. So I said, listen, why don't you give me an internship on the floor of the NYMEX? Don't tell anybody who I am. And I'm going to go down and take your most junior position as a screen clerk. So I went down to the NYMEX it was like '05. I think it was '05, and started as a screen clerk. And then I started talking about, you multiply 4.2 and divide, and all the other clerks were like, well, hold on a minute. You know the math behind a gas crack? You're not a screen clerk type of person. So I got moved up to the phones, and at that time on the floor of the NYMEX, everything was paper. So what would happen is the banks and the independent traders and even hedge funds sometimes would call you. Sometimes they would ask you what you thought, but mostly you were filling orders. So you bring your phone to the edge of the NYMEX pit and you go, where's May? Some big broker would turn around at the top step and say, 55 bid at 60. And you go, I want 100 for 60 or whatever. It was probably the most eye-opening 2 years, aside from being a new parent, I have ever had. I had no background in financial markets. I really was purely an Eddie Murphy. I mean, really, really, really matched the plot of the movie Trading Places. Aside from getting the front running the orange juice price before it came to market, did not do that. But just understanding what moved markets, certainly what moved markets when they were paper, how the locals worked as opposed to the brokers, it was completely formative. And when better minds than mine, who have written much longer books than I'll ever attempt, talk about fear and greed and the interchange between those two things, there's nothing like an open trading floor for really learning what that means, how it can take off, and how it changes not only someone's behavior during the day, but how it can really change a person's psychological physique.
Yeah, so a couple interesting things. And maybe I'll just posit an observation for the younger listeners about starting a career and the fact that you took a step back and said, give me the lowest rung on the ladder. While that might be a step back in status and maybe compensation initially, understanding how the machinery works is such an important skill. You could be an expert at your little vertical, but if the goal is to get out of that vertical or use it to do something else, looking left and right and understanding how things work is very, very important. And you're a testament to that. So if I take some of those lessons learned, fast forward 2+ decades later to Reuters, and some of the things you've been reporting on lately, which I want to get into some of the themes, less some of the stories, although if you want to quote any of them, feel free to do that. But there's always the headline, and the headline can be very, very interesting. But then the news story that sits below it can be so very, very complicated. And you, as a reporter, don't need to know every nuance, but to be balanced about where the opportunities and where the risks are is always very important. And while a screaming headline about the risk of a specific thing that might be warranted if a fund blows up, but if you're talking about a strategy and maybe out of favor in the short term, longer term, it may make great sense. And having that kind of thoughtful analysis is helpful. So maybe if I formulate that into a question now, what are some of the things you're seeing right now? And maybe you could talk about some of the pluses and minuses about what's going on in the marketplace, and specifically hedge funds, which I think is quote unquote your beat.
Yeah, I think hedge funds is the greatest beat to keep ahead of where exactly the beating pulse of the markets is, because hedge funds do have that flexibility to employ their ideas, to take risks. They're really on the front lines of where markets are going to go or not. I think at the moment, we're all waiting to see what happens in the next couple of months with U.S. growth. The U.S. coughs, the world catches a cold. I report out of London, but what do we care about the most? The U.S., the U.S., the U.S., the U.S., and also China growth quite a lot. And so I think our next big focus, particularly going forward with the U.S. election, the most important day to me this autumn, probably more than my birthday, is the Fed announcement on September 18th. I think we're all very eager to see even the difference between 25 and 50 basis points. That kind of decision is going to be making markets. And hedge funds are going to be taking their bets on that right now. Plus, August was an absolutely fascinating month. It was a real payback month for me because I had been looking at volatility for months, this big short volatility trade. And we wrote about it on the day on August 5th when markets really exploded after the BOJ remarks on Friday. But it was really the Monday where the markets saw huge spikes in volatility. I think that we are looking deeply at every level of what volatility means in markets in the moment, the way it's calculated, the way it works, and hedge funds as well are at the forefront of taking bets for and against volatility. You have tail risk funds, which buy index options or out of the money puts, which are to be a hedge for future volatility spikes. Tail risk hedge funds make long volatility bets generally through different kind of financial assets. And there are a couple of short volatility funds out there. Not too many, but there are a couple of hedge funds who collect pennies in front of the steamroller. I think that's the term for that, in front of the freight train. And I think we really saw that in August. It was a fantastic moment in the markets. So fascinating to watch the absolute spread in how you start with a spike in the VIX because of remarks made in the BOJ. And then you see world assets and de-risking, a huge tsunami of it that spreads all the way from Japanese trading hours to New York. And we're still examining how hedge funds did out of that, whether they did well or badly, and which ones did well and which ones did badly.
At the very beginning, Nell, I forget exactly your words, but you had an assessment of the hedge fund space, which was largely positive, which I agree with. I think it's the ultimate vehicle that can be, on the one hand, very strategic, but then also very tactical when opportunities present themselves. And we are in a 24/7 trading market, and there will be some dislocation where the right strategy can just jump right in and get in front of something and maybe make a quick buck. And we are long-term investors, and these strategies in some cases are long-term, but I think it's a very good balance. I wanted to ask a question about a couple of strategies, maybe starting with distressed, which you would think that this is the perfect storm for distressed, and that I think it was Bain recently reported that there are 27,000 portfolio companies over 4 years old, majority of them over 4 years old. They're representing $3 trillion of assets, probably levered up when rates were much lower. And the fact that that inventory of $3 trillion is going to clear the market and NAV is borderline laughable. But what is and what isn't? And I think the thoughtful analyst at a hedge fund could come in there and maybe start to get some things for 50, 60 cents on the dollar. Maybe not today, but I think that opportunity is going to be coming. But it seems like distressed, I think I just saw maybe in Reuters or someplace else that another distressed fund just recently closed as well. So what is your outlook specifically in the distressed space, if that's a vertical you spend some time covering?
Sure. Well, I pulled some numbers for you today. So I think, first of all, it's quite interesting that a couple of prime brokers do investor surveys, these investor surveys, and they talk to consultants and they talk to pension funds and they talk to sovereign wealth funds and family offices, and they get a feel for what investors are interested in. So I'd say distressed for investors, if BNP includes it in credit, it would be the second most. The prime brokerages don't tell you which kind of hedge fund fits into which mold. But credit is the second most sought after kind of hedge fund strategy currently in H2 2024. So investors are really looking seriously and distressed, and also corporate credit. Spreads are still pretty tight. Although I also pulled for you Pivotal Path, which is a data company, a data research firm, which looks at hedge fund performance, has distressed hedge funds up 9.2% for the year. So they're doing pretty well. I think what is interesting is, and we wrote about this at Reuters last December, and it took me about 12 months to carry off this news article. So I look forward to doing something similar again. It'll take me another 12 months. But last December, and I think the trend continues, we saw that the most profitable hedge fund strategies investors were redeeming money from, there were huge billions and billions and billions came out of macro and CTA hedge funds, which at the end of 22 were some of the best performing hedge funds. And this was because private equity redistributions were not matching capital calls. So private equity for their new vehicles were asking for more money from investors who had made commitments than those investors were receiving from deals that private equity had made. So there's an entire food chain, or if you like, aquarium of different fish floating around, I think, at the moment that particularly affects distressed credit. You have a huge amount of money going to amend and extend deals. You have a huge amount of money going to private credit vehicles, which have a lot of money to lend to distressed companies, which might be, what's the phrase? Good company, bad balance sheet companies. They might not. We don't know because we don't see the marks because it's all private. So it's still a tricky moment to be a distressed credit investor because, as you say, we don't see a lot of real current marks. And you need those to know that if the company is distressed or not. And if people are lending to the company, then it looks less distressed. So on Friday, I had an exclusive Davidson Kempner, which is a really huge, famous bond trading, but they also do equities. They have a multi-strat hedge fund. They decided that it was a tough environment for distressed investing and that they would be closing their distressed credit hedge fund. Now, that's not the whole picture because they'll still be trading distressed credit, but they'll just be doing that through their multi-strat. But one of the things they mention in their investor letter, which I got a hold of, which is that you have this whole ecosystem now where it's a little bit harder to tell which companies are distressed and which are not. And also, in line with that is my favorite day that we're all expecting, September 18th, which will have been passed by the time this podcast is published. Whether we see if U.S. growth, after this intensive rate cutting cycle, manages to style it out. I guess it's like back to the NYMEX. If you saw a guy with a bunch of pit cards, those could have been empty pit cards. Everybody in the ring would start to trade because they thought this one guy had a big order and they thought a big order would hit the market and move the market. We're at this moment where we don't see what's on the pit cards. We don't know what kind of risk people are holding. It's hard to tell whether the U.S. growth story will just take off, equity markets will hit new highs, or if the historical story we have after every rate rising cycle will occur and we'll see a recession or some kind of at least market washout or flush. So we've had a couple of violent spikes in the market, but we're not really seeing a full, to my mind, real flush. There are definitely deals have picked up and event-driven hedge funds are doing a lot better as well.
Maybe an observation and also a question at the same time. So I just got back from Silicon Valley where we ran Alts SV. This is a series of events we do around the world. I'm going to be in London week after next, so maybe I'll see you there for Alts UK.
I'll be there.
We talked about both there and I think Alts UK as well, this concept of total portfolio approach versus strategic asset allocation, where you're less focused on buckets. So if you need to top off one, you have to sell something someplace else and get it back into balance versus under TPA, you're looking at the total return of the portfolio. It's no more complicated than that. And every idea is competing with another idea in the portfolio. And in order for it to get in, it's got to be better than everything else I own or something else that I don't own. And I think with the DPI in private equity being negative since 2020, I think it's put investors in a bad spot in that those capital calls keep coming and they can't stop them. They have to meet them. So what do? They turn to the most liquid part of the portfolio. And I wonder with funds shutting down, that the fund, they are liquid, I guess, but they're not meant to be liquidated on T+1. If they're right about the specific holdings, that may not be today, it may be next quarter, but if they've got this constant threat of calls of the capital coming back out, it's hard having total conviction on your position. So I wonder, does that have an impact in terms of these funds constantly being open for redemptions and being viewed as liquid vehicles? Sometimes maybe people view them as a trading strategy as opposed to an integral part of the portfolio.
Well, just to note, that Davidson Kempner fund that closed, it was still up 5%. They didn't feel it performed in an outsized way enough because hedge funds are under a lot of pressure to achieve double-digit performance returns this year because rates are higher, but we'll get to that. I think that's why we've seen lockups increase. I think all kinds of hedge funds are now renegotiating their terms. We've written about this a lot at Reuters, where there's a more fluid conversation channel. Currently, investors are pushing back on, okay, well, you want to lock up my capital for 3 years. Now we got to talk about fees. Or, okay, I'll pay higher fees, but now I'm going to get my capital on a quarterly basis. And so there's a real change in the hedge fund world. And it's not happening in one big theme or on one big note in terms of investor lockups. But I think after what we saw in the last couple of years with investors redeeming on liquid funds, and particularly during the LDI crisis, a lot of hedge funds called their investors in the UK and said to their pension fund investors, do you need me right now? You can redeem, just please come back. And they did. And quite a lot of them came back, but some of them didn't. And we wrote about that as well at Reuters. So I think there is a push-pull at the moment in terms of, is it smart as a hedge fund to have a lockup period? Meaning, if I, as an investor, give a hedge fund money, at what point do I get it back? Do I get it back after a quarter? Do I have to wait 5 years to get my return on investment back? Do I get a certain amount back after a year and then 3 years and then 5 years? There are some hedge funds, notably some of the bigger ones, have really long lockups at the moment, like 5 years, whereas I think it's becoming pretty standard to have a 3-year lockup. And so I think hedge funds as well are trying to coax investors to become a little bit more sticky in terms of their capital behavior, because a lot of the bets that they're taking are not today, tomorrow, this month, but are longer term bets. That said, now that risk-free rates are, treasuries today are down to, I think the 10 years at like 3.74 or something like that. So rates are coming down. But for the last couple of years, investors are looking at higher rates and saying, well, I could park this in cash and get 5%. So why exactly would I be employing lawyers and getting compliance sign-offs for a hedge fund that's going to return me 1%? And if I don't know everything the hedge fund is doing, whereas I could put my money in U.S. treasuries and get the same amount. I got very exciting for an American overseas because I can't make any investments. And also as a reporter, I can't make any investments, but I got a savings account that was 5.3%. I was over the moon. But it certainly said something for me about hedge fund investments, because you see the returns of the hedge funds come in less than 5%. And you're like, well, I got a savings account that yields me that much. It's a very strange and tricky time for hedge funds. Plus, they're maturing as an industry. Hedge funds is not really a new beast anymore. It goes in the alt buckets, and the biggest players are becoming more consolidated, more solidified. They're now sort of luxury brand hedge funds as opposed to newer hedge funds. And I believe launch numbers are down for this year.
I think that the same is true of a lot of the private markets offerings, particularly private equity. These have become very, very crowded trades. They become more efficient markets, and the alpha has been not rinsed out completely, but you have to be much more selective. And there have been a decent amount of blowups over the years in the hedge fund space, and due diligence is very, very important. But the next best manager might be the manager that has a very interesting niche strategy. And they are saying, when I hit 500 million, I am closing. It's not going to be, I'll keep taking money. I can't continue to do what I do at 500. How these emerging managers get hired, they can't be hired by the bigger allocators because of their size. But I still think there's opportunity. But I agree with you. I think it's become a mature market, and a lot of the trades have become very crowded. I do want to touch on fees and democratization in the remaining minutes, but just maybe to park this side of the conversation on lockups. It's interesting, and maybe with Reuters as being the exception now, I think oftentimes when lockups and maybe redemption fees in the liquid alt space, when they get reported upon, it's the lament of the investor that's stuck and can't get out. Reality, and I think this is sometimes completely misunderstood, lockups are to protect the investor. Redemption fees are to protect the investor, not an ease of exit for investors that have decided to leave the stage, because every time the fund has to raise liquidity to meet those demands, it's impacting the investors that are in there for the long term. So just an observation, which I think maybe states the obvious. So I do want to talk about both fees and democratization, and maybe in that order. You alluded to it a moment ago, particularly with higher rates now, and oftentimes if it's 1.5 and 15 or 2 and 20, there are other fees tucked inside. And if it's a fund of funds, even more so. So you really got to make sure you have your arms wrapped around an alpha engine, because these are not inexpensive products. What are you seeing in terms of trends in fees? And maybe 2 and 20 is not the market clearing price for the big investor, but maybe some of the smaller plans are still perhaps paying that.
Increasingly, I think more and more hedge funds are changing to this pass-through fee model, which Barclays had an excellent note, which I got a hold of last year, which talked about how I think they calculated the average level of pass-through fees made it 7 and 20, which is a lot of money that you're giving up. They also, in the same, I think it was the same note, which also Reuters reported on, said that investors now give half or a little bit more than half of their money up, of their winnings from their hedge fund investments up, if they have their investments with a hedge fund that uses a pass-through fee model. So the pass-through fee model is, if your listeners are not aware of it, it means that the hedge fund can pass through their expenses. And so at the end of the month /year/3 years, whatever it is, the winnings of the hedge fund, you receive minus the hedge fund's expenses plus its 20% performance fee. So that is a real wrench in the story of the fee structure in hedge funds. It does allow big hedge funds to spend a phenomenal amount of money on technology, which I think really gives them an advantage in terms of what they're able to do, in terms of trading, in terms of how they build their models, in terms of how close they are to the latest data sets and how their data sets work and how their execution works. None of that is cheap. So is reg tech, I'm given to understand. Reg tech is a huge tech spend. And so those bigger hedge funds which use pass-through fee models are able to cover that with investors paying those pass-through fees. In terms of 2 and 20, I don't think we're seeing a huge amount of move towards 3 and 20. You saw a couple of hedge funds do it last year, which Reuters reported about. But I think actually in terms of 2 and 20 fee structures and the negotiation on that front, fees have actually come down. They're not actually at their high, according to Goldman Sachs research and Reuters reporting. So it's a tricky one with the fees, because if you talk about pass-through fees, you don't really actually know 2% of what or 20% of what. It becomes 20% plus what's passed through. And that does make a hedge fund an expensive prospect. However, a lot of investors surveyed by these banks tell them, look, I'm getting year after year after year, as though it were a US Treasury a really stable and positive return. So I don't care how much I pay on fees. I'm happy because this hedge fund is big enough, smart enough, has spent enough money on technology and all of its whizzy systems to return me a really stable and nice amount. So even on a down year, where I think multi-strategy hedge funds this year are returning, the biggest ones, the US ones, are returning under and just over 5%, which doesn't really match risk-free rates. Investors are still happy to pay for those pass-through fees.
As you said, average, you emphasize sort of average 7 and 20. That's a big number. But on a relative basis, if I've got a Renaissance type machine that's yielding me, you pick a number, 25%, netting 12, that's great. If it's 8 and I'm netting 4, I'm better off maybe going into your risk-free account that you have access to as an American citizen now at 5 and just call it a day. And I don't have any volatility to worry about. But anyway, we'll put that aside. You did open up a quick door. So before I finish with democratization, this tech spend, what are you seeing about generative AI? Is it nascent? Is it real? I'm sure it's real for some funds, but maybe more nascent across the spectrum of all hedge funds. What's your observation there?
For sure real. However, InfoSec is a real concern. So you have hedge funds that are still, I think, negotiating with AI companies as to how safe their data is. AI is awesome as far as I'm given to understand for cleaning up data. It's a virtuous circle. You allow your price data, which is super unclean, to be put back into the big data lake in the sky, and everybody else has access to clean data. It makes the data better, etc. It's all fine. However, if you have a handy little algorithm or something that is proprietary to your fund, the last thing you want to do is give it to an open forum where others might find some kind of prompt to say, if I was one of the big major hedge funds in the US and I was to type in this line of code, how would I finish it if I was Citadel? Or how would I finish it if I was Millennium? I'm not sure if you can actually do that with generative AI, but I do know and do understand that still there is an InfoSec concern. And I don't believe that hedge funds have en masse taken up the idea of just throwing up all their algorithms and letting ChatGPT-4 fix the coding.
Yeah, I agree with all that. And maybe a future fodder for many good stories and informative stories from your side. So now maybe finishing up with democratization, and I don't know where this stands in the UK, so it may not be necessarily in your wheelhouse, but giving investors greater access to uncorrelated risk premia is very much alive and well. Liquid alts came about probably around the GFC, so they're 15, 20 years old almost, and now the game has moved toward access to private equity, real estate, and using interval funds as a vehicle of choice. And put aside the leaky structure of interval funds quarterly, and we covered liquidity, but does the investor stand a chance, the average retail investor, around due diligence? And if they're just buying a hedge fund and don't have the ability to look under the hood and really understand the strategy and what they're getting into and fees that may not be overly apparent on the tin, so to speak, how are investors on the retail variety, should they be thinking about access to more sophisticated investments? Or is your view, and this isn't investment advice, stick to the public markets and stay fully invested?
That's an excellent question we could unpack over 7 days straight. So first, I'll take aim at your question, actually, and say, what is exactly a retail investor? Because during these Roaring Kitty episodes, I always loved the phrase retail investors being used, but I still know some commods guys who came off the NYMEX floor and they're trading retail, supposed quote unquote retail. It's that guy has 20 years of open outcry trading behind him. That guy's not the idea of if I put my 83-year-old mom in front of a trading program, although she's pretty well informed. I think she would do great. But anyways, yeah, it's a real range, isn't it? So we have these UCITS structures in Europe. You have very clear, delineated well-explained fee structures for the UCITS funds. Generally, they have limits on how much volatility they can take. That is also clearly explained. All of the information for the retail, the UCITS funds are very well marked. They receive monthly and quarterly reports. There's daily liquidity dealing. So in terms of a retail structure there, it's pretty sound structure. However, because of the volatility limits, for example, we come back to distressed investing. If a volatility limit exceeds a certain amount, hedge fund has to let go of the position. So if you're in the middle of an M&A deal, the volatility level of what you're holding in a UCITS fund could spike, and then actually you would miss the move in the M&A deal. So there are some considerations to be made. In terms of retail as well, there's a lot of retail traders doing zero-day options. I'm not going to voice an opinion of what I think, whether I think retail zero-day options is a good, bad idea, but it's a structure that really suits a trader that's not going to take 100,000 lots. It's a structure that suits small positions, being able to be really nimble, getting in and out. And in terms of retail trader, I guess like me, I would be a retail trader if I was trying to decide what was going in and out of my pension pot. I guess with my past, I would like much more oversight and much more clarity, I think, from my pensions providers as to what kind of alternative assets I could get myself into and how those would work and what the volatility thresholds would be and what kind of asset classes these would be involved in. There's a real range of how much information is available to investors depending on what kind of investor you are, at what point in the investment cycle you meet that investment. I do think it's super tricky for institutional investors, particularly pension fund trustees, with the lack of a huge amount of money available to them, to have a line by line and go through line by line every kind of investment that they have. So I think for me, I'm always about transparency increasing because that benefits me, makes my life easier as a reporter. And so therefore, when I'm talking to investors, it makes it easier for me if people have been transparent with them. But sometimes investors don't want that. They don't have the time, which seems like a strange idea to me, but I haven't done that job. I haven't filled those shoes. I don't have committee meetings. I don't have that boss. I don't know what that boss is asking. So I don't think I can be in a position to judge. But yeah, I think that's a very wandering answer there.
And I think it underscores the fact that it's complicated. And I think the consumer, when they make choices about their health or dental care or going to have a car fixed, you're putting your trust in that vendor. And you could go and get a second opinion. And many times, if it's a life or death situation, we do. But I think with investments, I think too often we get wrapped up in the narrative or what the product could do versus what it's likely to do. And more importantly, how does it fit into everything else I own? And if the value proposition around just limiting volatility is being rinsed out, what are the chances I'm going to get something that's undifferentiated from a public market index after all is said and done? I don't know what the answer is, but I think oftentimes these correlations continue to approach one, the more regulation and restriction is put in place. But then the flip side, and I'll leave it at this, is that back here in the good US of A, if I look at my 401k plan, the employer has no incentive to put an interval fund in there. They have no incentive to put a private fund in there. There's fiduciary responsibilities. Does the average employee understand it? So what do I end up with? Uninteresting public market proxies that are probably mostly index funds, which is not terrible, but if capital formation is happening in the private markets and upside is going to be in distressed or in the private credit space, I need to find ways of getting access. So maybe we'll have you back to talk more about this. I think this is an evolving trend, and I'm not sure what the solution is. But I did very much enjoy the conversation. Your smarts, your curiosity, the way you deliver it with levity really is quite pleasing to me as a friend, and also reading what you write. And by the time this airs, I guess you'll be one more year young. So I'll wish you an early but belated happy birthday by the time this comes out as well.
Thank you.
Nell, thanks for all you do and appreciate your time today.
Likewise. Thanks, Bill.
Thank you for listening to Educational Alpha. I'm your host, Bill Kelly. Learn more about the CAIA Association and subscribe to the show at caia.org. That's CAIA.org. See you next time.